This is a wheat future, and wheat and other physical commodities often have storage cost. Financial indexes don't have storage cost, and so a real commodity storage costs increase the price of the future to the buyer because the actual uh, provider, supplier of the asset would have to store that asset before selling it at a later date. So when you look at the wheat futures formula, you'll notice that, again, it's spot price, carrying costs due to financing, storage costs. But there's this one other factor. It's called a convenience yield. And that is basically a speculative guess as to where prices will be due to differences in demand and supply at that time. You can say it's a result of differences in demand or supply for something in the present, true. Either way, it's a speculative difference apart from the actual cost of keeping the asset. So looking at the wheat future, here we have 426 is where the future trades. 418.5 is where the spot is. Risk-free rate 1.4%, storage cost 2%, and the typical convenience yield is 4%. Problem asked, can you calculate the one that they're using? So the first thing to do is kind of organize your information. So we have our spot, where the future's trading, and we can go off and calculate the fair value pricing of the future. Well, the fair value pricing, let's say that the typical convenience yield is what you'd like to plug in for Y as a fair value convenience yield. So over here, I've got my risk-free 1.4 storage cost plus 2 minus the positive 4% convenience yield. Have a negative sum. Raise that to the power for the portion of the year. It's a 3-month future, so it's 1/4 of a year. And you'll get 99.85% of whatever spot is. So the fair value pricing, 417 and 9/10. And you see that the traded futures price is well above that. So the only thing that can differ here is the convenience yield that the market is using on that particular day. And if you wanted to trade this and suggest that the market's going to correct back to fair value pricing, well, we'd probably go short the traded futures price and reverse it later. However, if we're just wanting to know what the convenience yield is based on this traded price of 426, well, the pricing formula is the way to do that. We just isolate things until we just have Y left. So how do you do that? Well, take the formula, take spot price over to the left-hand side, take the natural log of both sides, and then it becomes really, really easy. So you end up with a 1.78% as basically the sum of whatever the market was doing when it traded the future at 426. We could subtract off a 1/4 year's interest, a 1/4 year's storage, leaving us with a 1/4 year of convenience yield. And note that the plus 93 basis points here is negative Y on this side. So when you really want to know why, you're going to have to put a negative sign in front of this. So if we do that and we gross it up to an annual by multiplying by 4, we find out that the convenience yield for traders on that day was a negative 3.7%. So if we think that the market's going to correct, obviously negative convenience yield subtracting the negative adds to futures prices. Futures price appears to be too high based on the little information that we have. And we might either wait for prices to go back towards fair value near 418, or decide that it might be a potential for someone who wants to trade basis and try and arbitrage it. So that's a wheat future: storage cost and convenience yield.